So for my next question,
Mhm.
should I form a holding company to manage my multiple businesses?
Like whether it's to do so in the end, a holding company doesn't accomplish anything tax wise because everything's going to be flow through, and so it all comes out the same. What it does do, it allows for better organization and allows for better use of resources. Because if you have multiple businesses, a big problem that people get into is so I've got this program that I pay for over here, so I'm going to let this company over there use it. Is that really right? Really, what you should do is company A should be charging company B for the use of company A's resources. And yeah, it's a wash tax wise because the income on one side balances out with the expense on the other. But in order to have accurate books that represent reality, that's really what you should be doing. So when it comes to having a holding company, then you can do those things like parent to child in terms of the entity relationship rather than brother to sister. It can make for much cleaner books. And that happens a lot with staff. So if you've got somebody who works in company A who does, I don't know, bookkeeping, let's say, and you also have them do bookkeeping for company B, but you don't charge company B for it, then what are you doing? And so you're not accurately reflecting the reality of the situation in order to get things done. Again, on a tax basis makes no difference, but for organization and for clean books, yeah, generally, I think it's a good idea. It becomes more important when you have businesses in your portfolio that are joint ventures with others. So if everything's yours 100%, then it doesn't matter. But if you've got three businesses that you own 100% and then you own 50% of another business that you have a partner on, then it becomes critical to have that organizing structure so that the one doesn't throw everything else out of whack. And if you want to, we did a webinar, I don't know, year and a half, 2 years ago on partnership setup kind of stuff, which goes into all that. I think that's on the Explorer side. I'm not actually sure. The organizational principle remains true that you definitely need a home base for everything to come into that you can do all your adjustments on. And that way just keeps everything cleaner. So in general, I recommend it. It does increase complexity of things and all that kind of stuff, but it's worth it in my opinion.
Yep. So yeah, you guys heard Neil. Go get that started. It's the better organization, right, Neil?
Yep. Most of the time.
Most of the time. Right. So we have another question that came in. It's a tax strategy question, Neil. Someone wants to know, how can I use charitable remainder trust to reduce capital gains taxes?
CRTs. Okay. So charitable remainder trusts are very complicated. Basically, what you're doing is you're giving up possession of something like a house or a stream of income or something. You're putting it into this trust, and it is going to be used for the benefit of somebody. Oftentimes, it's a spouse for their lifetime. And then after their lifetime ends, they pass away, then it goes to the charity as whatever the remainder is. That's where the name comes from. And so it gets very complicated because it's going to depend on the actuarial value of the assets that are put into the trust and are and that's going to depend on the life expectancy of the person who's the beneficiary. If you do it for somebody who is 20 years old, then the charitable remainder of value is going to be very low because the person who's 20 has a long time to live. They're going to use up most of that value. If you do a charitable remainder trust for somebody who's 80, then the charitable value of that is very high because the person who's 80 doesn't have a long life expectancy at that point, and most of that value is going to go to whatever charity it goes to upon death. So super complicated. The lawyers love them because they charge a lot of money for them. And in general, not my favorite way to do things, just because people don't get quite the benefit that a lot of times they think they do. Now, the thing with trusts in general is that every trust is different. Every lawyer has their own way of doing things. And so the specifics really matter a lot when it comes to trusts. And so you have to be really aware of what is going on, what the monetary impact is going to be, whether things are revocable or irrevocable. Because if it's revocable, you can take the thing back, then it doesn't count for anything for taxes. If it's irrevocable, that means you're putting it in this special bucket and you can't touch it ever again. Got to be aware of all these things. And there have been some cases recently about some abusive trust structures that have been disallowed by the courts. So there was one going around a few years ago. They created a spendthrift provision. Basically, This trust is set up for the benefit of Joe. Joe can't manage his own money because he's a wastrel. And so the trust is going to manage money and pay stuff for Joe so that he can survive, right? That's a spendthrift provision. And there are some special rules that go along with that. Basically, the trust doesn't pay any taxes at all, was the pitch. And a lot of these were found to be overly aggressive and got thrown out. And the $100,000 that the lawyers were paid went up in smoke to set these things up. And then the owner of all these things had to pay fines and penalties and everything. So be very careful with those kind of trusts. Now, trusts absolutely have a place, but it's usually at end of life rather than trying to live the next 50 years out of a trust that is never going to pay taxes. So that kind of pitch, be very careful about, just because, again, it's a thing that has been abused. It's a perfectly legal thing. People abuse it, and it increases audit scrutiny. But yeah, if grandma needs a place to live, a charitable remainder trust might be appropriate.
Right, well, thank you for that.
Yeah.